All right, with that, let's get cracking on individual stories. A quick update on the market action this week. Dalal Street snapped its six-day gaining streak on Friday. The Nifty fell sharply, went below the 11,000 mark to close around 10,943 on Friday, while the Sensex slipped over 400 points, nearly 425 points. Tata Motors was the stock of the day. On the downside, fell 18% and ended at an 8-year low after it reported a shocker of Q3 earnings. For the week, both the Nifty and the Sensex ended flat. The mid-cap index, though, tumbled over 2%. But the top story this noon, there could be some relief for India's startup community on the controversial angel tax issue. Representatives from the startup community met tax officials yesterday. Angel tax, remember, is a 30% tax that is levied on the funding received by startups from an external investor. However, this 30% tax is levied when startups receive angel funding at a valuation higher than its fair market value. We learned from sources that the exemption limit on angel tax could be hiked from 25 crore rupees to 50 crore rupees. And here are the two members of the startup community who attended this meeting with tax officials on what we can expect. Hear it out.
What we also got to know that the action which has been taken under Section 68 and not Section 56, and the notification of the 24th of December pertains only to Section 56. As in when DIPP does come up with a notification, it seems they will be taking out notification for all the existing startups which have got orders, in fact, that at the time of appeal, the new regulations should be considered.
The solutions that were actually proposed and spoken about during the meeting today will actually go in giving relief to about a majority cases, as you mentioned as well. Even in terms of Section 68, they will be issuing a separate notification itself and a clarification stating that in case any startup gets a notice under 68, either the startup can respond to it or the investors can actually respond to it, which will go a great way in actually reducing the amount of friction between startups and the department.
All right, with that, we go on to some important opinion coming in from the former Reserve Bank Governor Y.V. Reddy. He's spoken up for the RBI's autonomy on several issues. At a speech delivered in Pune's famed Gokhale Institute on Friday, Reddy said that if the government wants to help the small and medium enterprises, the money should come from the budgetary sources. It should not ask the RBI to design a package that banks have to obey. The former governor also spoke out on issues like RBI'S capital and the government forcing changes to the PCA or the Prompt Corrective Action norms. Lata Venkatesh has more on this. Lata, take us through the highlights of this speech and what do you make of it?
Well, actually, Dr. Reddy's speech is a massive 32-page account of the historical relations between RBI and the government from the time of its inception, from the time RBI was nationalized by the government before independence. But what is interesting is his comment on the current 5 problems, as he puts it, between RBI and the government, and he comes out very strongly in favor of the RBI. First, he speaks about the SME package. He says a package to help SMEs should come out of budgetary resources. The government cannot mandate the RBI as banking regulator to prepare a package which is mandated on banks. The underlying assumption being the depositors' money is not something on which the government should make rules in favor of any sector. The second point he raises is on RBI'S capital. While he admits that there is a committee looking into it, he says the idea mooted by the chief economic advisor that RBI'S capital should be directly transferred to banks to capitalize them is constitutionally improper because the RBI'S capital, its dividend, is the property of the Consolidated Fund of India. So Parliament should have a right to rule over it. It cannot be directly transferred to the capital of banks. On Basel III rules, which is, which faced a lot of criticism with the government saying that RBI is being holier than thou by recommending higher capital than Basel requirements. He says that it is required in India because in India the ability to recover money from a defaulter is very less compared to international standards. The loss given default is very high and therefore higher capital norms are required in India. With respect to the demand that a line of liquidity be given to NBFCs when they are in trouble, he takes the IL&FS case and he says it is not a liquidity issue, it is a solvency issue. IL&FS has probably become insolvent because some of the loans will not be returned at all. It is not a liquidity problem, it's a default problem. And finally, with respect to the powers of the board to dictate to or order the RBI governor, he says the composition of the board, the method of selection is such that it cannot be given, it is composed in such a way that it has to be advisory. If it is going to get mandatory powers or powers to mandate the governor, then we have to have a comprehensive review of how the board members are selected, how the governor is selected, and what should be the responsibility of the governor. He can't be asked to, deliver on certain issues and the board dictates to him, but the board is not coming before Parliament and being answerable. So a comprehensive review of everybody's powers is needed if the board is going to be made more powerful than the governor. It's a very powerful speech coming to the aid of RBI on several issues.
All right, Lara, thanks a lot for that. A very powerful speech coming to the aid of the RBI governors as well as the autonomy of the Reserve Bank of India. With that, we move on to an important corporate development that took place. Now, Anil Ambani's Reliance Group lashed out at its lenders for invoking the pledged shares. The group termed the sale by L&T Finance and Edelweiss Financial Services as illegal and excessive. Remember, the RCOM stocks or the Reliance ADAG stocks were down anywhere between 40 to 60% in just the last few trading sessions. In a strongly worded statement, I read, and I quote, the manner of conduct of the above open market sales without any attempts whatsoever at orderly market disposal through a bid or structured process for shares comprising the holding of the promoter group is also illegal on several counts, including, amongst others, price manipulation, insider trading, front running and market abuse, and is in violation of various regulatory provisions. End of quote. A strongly worded letter. The lenders did not take this lying down. In a statement, Edelweiss Financial said, and I quote again, "Despite our best efforts, not only did Reliance ADAG Group fail to address any of the concerns raised by the Edelweiss Group, but also continued to breach contractual obligations." End quote. Not just Edelweiss, we also had a comment coming in from L&T Finance, hit back late last night, and I quote again, "The borrower did not cure various events of defaults, including providing for margin for the shortfall in the stipulated security cover." End of quote. In fact, just to take this discussion forward, we have Mr. Sriram Subramanian, who's the founder and MD of InGovern, who joins us with his view on that. Mr. Subramanian, I read out Reliance's words, and it uses heavy words like price manipulation, insider trading, front running, and market abuse for pledged shares being invoked. What are your first thoughts on this, and do you think that Reliance's allegations will hold water or have some truth in it?
No, I think at the end of the day, it has to be recognized that these are allegations. So, and one is not sure as to what is the basis or the evidence on which these have been made by Reliance. Because I would find it difficult to find any manner of sale to be taken up by the lenders. So I think from that perspective, Reliance would find it hard to justify or provide any evidence on all these allegations.
What do you make of the retort that the lenders have come with? They are saying that they only asked for some data which Reliance Group did not comply with. There was a breach of contractual obligations, which perhaps propelled them to sell those shares in the open market. So, what do you make of the lender statement coming by?
So generally, if you look at this, when there is a default, the lender would write to the borrower and say that, look, the collateral is insufficient, so please top up the collateral. And in this case, that could have been the case over the past few months, as now the lenders at Edelweiss and L&T Finance have put out. And so if the margin collateral hasn't topped up, obviously, they are at liberty to go and sell. And given that the stock started tanking, so the collateral value started depleting quite fast. And as it happens in this one, it's like a circular cycle going all the way down, because the more these margin people sell, the more it's going to happen. And this was seen even in 2008 financial crisis. So this happens quite often, and it's a known phenomena that when there is a margin call, it cascades all the way down and it has a spiraling effect downwards. So there is no orderly manner in which the lender is supposed to sell, and that is not stipulated in any of the contracts between the borrower and the lender, and I would think that would be the case even in this particular instance.
Fair point, Mr. Subramanian. Before we let you go, two quick questions. Where does this go and what happens from now? Because a lot of the other lenders are also there. Will this invite further selling in the markets? And secondly, more importantly, what repercussions does this have on other companies where a lot of stake is pledged? Case in point, you have Z. They too have come to an agreement with the lenders on pledged shares. Something like this could perhaps happen out there as well. So what happens of this case, and what could the repercussions of this case be on other companies?
So definitely, people would have taken margin collateral and would be watching it very, very closely. And if the margin collateral is not fulfilled or held in this fund by the borrower, so they have to expect such a downward spiral. And this standstill agreement by Z with the lenders is something which is strange. But I think borrowers should expect such a selling henceforth, because lenders will be watching the collateral limits very, very closely.
All right, Mr. Subramanian, thanks a lot for joining in and giving us that quick analysis of what you make of this situation. We'll keep coming back to you all through the course of the development of this case. Now, in key earnings, Sun TV yesterday reported a strong set of third quarter numbers. Both revenues as well as profits have seen a growth of over 30%. Our media analyst, Nupur Jainkunia, joins us with all the highlights. Remember, the stock ended at the low point of the day, has been an underperformer. Let's see whether this can turn tide around for Sun TV. But Nupur, reported numbers look better than estimates?
Yes, correct. Sun TV reported a strong numbers for the quarter 3, above the street expectations. Revenue grew by 32%. We were working with a number of 19%. While operating margin improved to 73% versus 72% a year ago. But it is to be noted that depreciation was higher during the quarter by about 54%, which led to the margin growth. Profit grew by 32%. We were working with a number of 21%. Revenue growth was led by ad revenues, which grew by 13%, above the pool of 9 to 11%, while subscription revenue grew by 24%. Over the con call, management guided double-digit ad revenue growth and 20% subscription revenue growth in FY20. And also they said that the digitalization in the Tamil Nadu market will get completed by June 2019. They also said that they are on the track to ramp up their OTT platforms. Motilal maintains buy rating on the stock with a target price of Rs 750 per share. But remember, most important, the loss of market share in Tamil Nadu from over 60% just a year ago to 39% in the second quarter remains the big overhang on the company. But with the good Q3 numbers and the positive management guidance, let's see how the stock reacts on Monday. Currently, it's trading at 14 times FY20 expected earnings. All
right, Nupur, thanks a lot for that. So, ladies and gentlemen, that was our latest entrant to the research team. That is Nupur Jainkunia. You'll be seeing more of her on air going forward, tracking everything that takes place in the media space. So with that, we move on. A panel of state ministers led by the Gujarat Finance Minister Nitin Patel has recommended that 5% GST without input tax credit be levied on under construction residential houses. Remember, under construction properties are currently taxed at 12%. Further, the group of ministers has also recommended 3% GST to be levied on affordable housing without input tax credit. So what impact is this going to have on the real estate sector? Timsil Jaipuria reports on this, how this move could actually impact the sector, whether it would be cost push, and will the real estate companies go ahead and take that price hike?
Well, that's right, GOM on GST issue pertaining to the treatment of real estate today met under the chairmanship of Gujarat Deputy CM Nitin Patel, and the GOM is likely to have decided that the GST rate on under construction real estate should be pegged at 5% without ITC. When it comes to affordable housing, it should be 3% without ITC. Remember, both these two slabs already exist under the GST framework, and government feels that they now need to pass on the benefit to the home buyers. And they also feel that there is one tricky issue which again needs to be talked about, that is whether the government should allow TDR. TDR, remember, is transferable development rights, which currently developers enjoy, and they want the treatment of TDR to be clear once government announces these SOPs. So the GOM today decided that over the next 2 days, they will further thrash out these details, further thrash out the idea, especially of TDR, and then submit its final report to the GST Council, which will take a final call onto how should be the rate rationalization when it comes to the GST issue on real estate be done. So here is a word that sources are saying that the two key main issues, that is 5% without ITC on under construction property and 3% without ITC on affordable housing, is almost sealed. Let's see what happens finally when the GST Council meets. Back to you.
All right, MC, let's see what finally happens when the GST Council meets. Let's take a look at some of the national headlines or national news that are making the headlines. Kolkata Police Commissioner R. Rajiv Kumar's CBI questioning began today in Shillong. CBI officials are set to question Kumar on his alleged involvement in the Sarada chit fund scam. This comes days after West Bengal Chief Minister Mamata Banerjee's standoff with the officials of the CBI. The Enforcement Directorate is questioning Robert Vadra for the third day in a row. The agency is probing several properties allegedly belonging to Vadra in London and his connections to an arms dealer. Vadra has received immunity from arrest till next week from a Delhi court. Meanwhile, in Rajasthan, the Gujars are sitting on railway tracks seeking 5% reservation in government jobs and educational institutions. 14 trains were cancelled and 4 were diverted due to the protests. The Congress party came to power in the state in December and had promised reservations to the Gujars. Prime Minister Modi is in the northeast. He inaugurated a new airport in Arunachal Bhutan in Guwahati. He was greeted with black flags. But in Guwahati, he was greeted with black flags and angry protests. The key reason is the Citizenship Amendment Bill, which was passed by the Lok Sabha, which offers Indian citizenship to non-Muslims from Pakistan, Bangladesh and Afghanistan. All right, with that, it's a wrap on Business Saturday. Thank you so much for watching. Stay tuned to CNBC TV 18, a whole host of weekend programming coming your way.